What's up guys, welcome back to another video and thank you for being here. Today I'm going to show you when should you stop trading and to avoid bad price action. So before we start, if you find this video helpful, make sure to leave a like on this video and subscribe to the channel if you are not already yet, and let's get started. So starting the day, we want to know what news do we have for this day. So today is August 13th. We had PPI at 7:30 or 8:30 New York time. It's 8:30 my time. So on the 1 minute here, this is what we're looking at. I'll show you and explain to you what are these, and I'll show you a couple of things, but let's see the higher time frame. So the higher time frame, I came into the day and I marked two things. I've marked this bearish fair value gap on the 1 hour, and I've marked the beginning of this next bearish fair value gap with this red line. And I went down on the 30 seconds and I was looking for basically a buy towards these drawn liquidity. My first drawn liquidity was this box because it's the bearish fair value gap on the 1 hour. So when should you stop trading? I came into the day, I logged in and the price was like right around here, 7:51 or 8:51 New York time. So 7:51 my time, and I already like seeing this setup in play already. So I did not want to FOMO in, did not want to jump in a trade. If you don't know what I'm talking about, why I'm taking this trade, it's because we have a news wick right here, and we usually, when we have a news wick, we go to it, and we made a manipulation leg right here, and we're sweeping a liquidity inside of this bullish fair value gap, getting a IFVG or inversion fair value gap in here, taking the trade here, stop loss here, and taking your trade to the news wick. And it worked out beautifully, but it was very choppy, and you might have gotten stopped out at break even at the end of the day just because we made another manipulation here and whatever. But if you want a detailed video, I already made a video on it, on this exact strategy. I'll link it to the top right corner of the screen if you want to watch it. So seeing this play out in front of my eyes, but I was not around the chart, I was logged in a bit late. So the next play that I saw was right here, right? Was this bearish fair value gap that got inversed. And why is this good? Because we also kind of the same thing, we swept the liquidity right here, right? We swept the liquidity and we still held this bullish fair value gap. So that is why I was interested in this play, and I did not take that play either just because we were like consolidating. This was a really good play, but I just missed it because it moved too quickly. But this is when you start to start the FOMO with you and start getting emotional. You get like a little greedy and you keep like complaining about why didn't I take this trade worked and all of that, and this is when you should be stopping to trade, and you should not be looking at the chart anymore. Because look at this, because I'm a little bit disciplined. I'm not gonna say that I'm very disciplined. I'm a little bit disciplined. I sat through all these and I watched it, and I watched even this one play. I did not take it. Why? Because we are in consolidation range, and this is your sign to stop trading whenever we chop around and then the market gives you what you want. No, you should not be taking these plays. If these are your plays, you should not be taking them for one reason: because of consolidation range. When you come into the day, looking at the chart and look that you see that you missed already one good setup and then two good setups, this is your sign to close the chart and leave. And this is exactly what I did. If I refresh the screen here, this is what I will get: a manual lockout. What happened is I manually locked my accounts to protect my own capital and my own profit. Why? Because you already saw two good setups play out in front of you and you missed them. You did not take them. You were not around the chart for any reason. If you missed those trades and those were trades that you were supposed to be taking, then you should be like getting off the chart. Why? Because if you stay around the chart, you will get like absolutely like killed by the consolidation or whatever, just because we had two good moves right here, one here and the Newsweek strategy, and you just missed both of them for any reason. And then the price, just because the price delivered good enough for those drawn liquidities, or the two setups worked, and if you were around, you could have taken them and take profit, but you didn't because of any reason. Then the market starts to consolidate, and this is a bad like price action to stay around and watch. And after that, right after that, it gives you what you need. It's not gonna work most of the time. It worked today, okay, it did work today, but it's not gonna work most of the times. And another sign to show you when you should stop trading is when we get a couple SMTs in two different directions. So look at this, between this low and this low right here, right? Actually, this low right here, between this low and this low, we had SMT, right? Bullish SMT between ES and Nasdaq. We already have an SMT up here. It's bearish between this high and this high, and also between this high and this high. There's like two different or three different bearish SMTs, and the price not going down, and then we get a bullish SMT, and we keep getting like SMTs after SMT after SMT. That's not really a good like price action to trade and to stick around to watch. And these are the type of days and times that you should be getting off the chart and just logging out of your accounts, whether it's funded or evaluation accounts. You should be getting off, saving your capital, and just coming in a different day. Because if you missed two trades, and I came into the day, I wanted to take a trade, I missed this trade and I was not around the chart when this happened. I came logged in like halfway, so I didn't even want to take it, and I'm not going to take it when it came back to my entry here. That's not a good trade. That it might be a loss and it continues to reverse, so who knows. So that's not a high probability trade to take. But anyways, I did miss this trade. I missed it for one reason, because it was only 1-to-1 and it was risky. The stop loss was big and the take profit was not there for me, so I did not take it. If you missed those two good trades, I myself came into the day, I wanted to take a trade, and after seeing those two plays play out, I still wanted it to take a trade. And I know once you start thinking about it from the money aspect of things, this is when you get wrecked so bad. So what happened is, once I started to think about, oh, I can like take $20 scalp move while this candle is moving, and nothing is behind it to kind of make it a good setup. It's not an even setup, no confluence, nothing. How did I know it was gonna dump right here at this time? So you never know. So once I started like talking in my head and thinking that, oh, I could have just taken just like maybe $200 and leaving or so, right? No, once you start thinking about it from the money aspect and ignoring the actual setups and what the market is showing you, please, please, please do yourself a favor and lock yourself out of these accounts. Because if you don't, trust me, it will work once in your favor, but 9 out of 10 times it will destroy you. And this is one of the reasons why a lot of people, even ICT students, blow their accounts. So these type of market conditions are when people blow their accounts, because they don't know when to stop looking at the price action and when to stop trading in general, and just log yourself out of the charts and just go do something else. Trading is not about like milking the market out of money and just making $100 left and right, or small profits, or making $1,000 left and right, because trust me, I am positive you cannot make $1,000 here in these consolidations unless you over leverage, and when you over leverage you will get destroyed even more. So I'm pretty sure you can't make thousands of dollars here. So what are you gonna stick to? Making $100-$200, and it's not going to work all the time. It's not gonna work in your favor all the time, and it might work once or twice because of gambling, luck, whatever. It's in consolidation, guys. It's gonna go up and down, up and down. Even if you like come in a random spot and click buy, it's gonna go down and then come back up if it is consolidating. And once it starts breaking down or pumping up, anyway, moving away from this structure, from this consolidation area, this is when it hurts the most. Because as you can see here, if you like click buy on at this level and you see like this big rejection and dump down, you're gonna think to yourself, and you're like at this level, right? Let's actually put it on the chart. Like you came to the market, and at a random spot you clicked buy here, and the market went to your favor a little, and then it dumped down. What are you gonna think? You're gonna be like, oh, we took out this low or this low with this big bearish momentum candle, we're gonna continue dumping, and this might be a market maker sell model or whatever, and you like end it here at a loss. And then the price, because it is consolidating and it's not time for it to leave this structure, because we never know when is it ready to leave the consolidation range. It went back all the way back up, and it went to your TP. By the time you become at this level, you get more and more FOMO, and you want to over leverage to kind of like accommodate and gain all the other losses that you lost right here. While it was a good trade in your eyes, in other people's eyes, this is a consolidation, you shouldn't be trading it. But just beginner people that gets stuck in consolidation ranges and don't know when you should stop actually looking at the chart and actually stop trading, because it's consolidating. It's not everything is gonna fail when we're consolidating, guys. Every single setup or trade strategy will fail. I promise you, and I guarantee you it's going to fail miserably. So just trust me on that. If you don't want to trust me, you can learn it your own way, the hard way. It's up to you. But this is just part 2 of when you should stop trading and when you should avoid bad price action, and how actually to spot bad price action. It's when you start getting bearish and bullish SMTs at the same range, you should just stay out of it. Stay out of it. So that is it for today's video, guys. As you can see, today I did not make any money. I did not trade at all, just because I want a good safe trade that has setup confluences behind it. I don't want to jump in moving candle and just taking like $5-10 out of it or whatever. I want to take good setups first. So yeah, that's all for today's video, guys. Thank you all so much for watching. I will see you in the next one. Peace.